Welcome back. Let's look at managing the most important risk of all, the revenue risk. This is the risk that the expected project revenues do not materialize. That's the income you're expecting, the cash inflows, and by now you'll have identified that this would be a disaster. If that happens after your project has closed, it's a disaster because there will not be enough cash flows to service your loans. That means the project company cannot pay the interest and contractual loan repayments, and then the project company will be in default and it may go bankrupt. Even before closing, in the preparation phase, this would also be a disaster. If the investors or lenders identify that the revenues could fall away, then no investor or lender will give you the funding that you need. In that situation, the project will fail before it even starts. Usually, when people complain that banks are not prepared to lend them money, that's because they have been unable to convince these banks what the expected revenues will be and how secure these revenues will be. So both in the preparation stage and in the project operation stage, it's crucial that you know what revenues the project company can expect. When we spoke in the previous video about stabilizing revenues as a crucial act of risk management, this will be the top theme that we focus on. Before we can start to secure the revenues, we need to determine what those revenues are. For this, we'll need to determine how much of a product or service the project can realistically produce. For example, how many megawatts of electricity can it generate if it's a power plant? 2, who the potential buyers for this product or service are and what their demand will be in the coming years. And then 3, what price they will be prepared to pay. When you have this information, you can calculate the future expected cash inflows. The revenue that we are trying to assess here is the quantity of the products we sell times the price per product. Let's look at how you secure the revenue flows, how you stabilize them. Pause this video for a moment and think about how we could do that. Did you think of a solution? In project finance, whenever there's a market buyer, we aim to sign an offtake agreement. This is an agreement with the buyer that states that the buyer legally commits to purchase every product every year for a contractually agreed number of years. This offtake agreement needs to specify the quantity of products that will be purchased and the price at which these will be purchased. And then the agreement needs to specify the period over which the purchase commitment runs. Usually, this must be at least as long as the term of the project loans, because the project lenders are the most risk averse. They will need the comfort of an offtake agreement at least as long as their loan is outstanding. Then also, the offtake agreement will specify what happens if the product is not purchased. Usually, the buyer will be liable for a penalty. We call this a take or pay contract because you either take the product or you pay the penalty. Negotiating an offtake agreement will be tough because the buyer will not be keen to give you such a large commitment for so long a time. It will mean that the buyer assumes the market risk, the risk that there may be less demand for the product, for example due to an economic downturn, and the price risk, the chance that the market price of the product falls in the future. We have, for example, seen an economic downturn that started in 2008, that the demand for electricity has fallen, and so has the price. So if the power project company had signed an offtake agreement, then the power utility, its buyer, would bear this risk and not our project company. The buyer will not take on this risk unless it gets a reward for doing so. It may only be prepared to pay, say, 95% of the current market price, the 5% discount being the reward for assuming the risk. For the project company, it will be a trade-off between the lower but more secure revenues and cheaper funding, or higher but less secure revenues and then more expensive project loans. If the project company does not have the security of an offtake agreement, the lender will run more risk, and he will require higher funding costs. The saving on funding costs can outweigh the lower revenue. Finally, not all projects produce a product that can be sold. Imagine a project company that has been given the concession to build a stretch of road and to make that road available. In most countries, road users do not pay for the use of a road. How could the project company be given the opportunity to raise the revenues that it needs to fund this road investment? Pause the video again for a moment and think about this. In broad terms, there are two basic earnings models. First, the road users could be asked to pay. The project company could charge toll fees. These toll fees then would need to be sufficiently clear and predictable to satisfy the lenders. A second alternative would be that the concession giver, usually a government, agrees to pay a fixed price for making the road available. This model is often referred to as a PFI, or Private Finance Initiative, a form that was first applied in the United Kingdom. It has the benefit that the project company does not run any road usage risk. It will get a fixed fee per day the road is made available, irrespective of its use. Variations in the road use are no longer relevant for the project company. The government is usually better able to predict and influence the use of the road, for example by setting the costs of fuel and car ownership, or by creating public transport alternatives. That is why this model is efficient in allocating the risk, in this case the road usage risk, to the party that is best able to assess and manage that risk. This financing model is most often applied here in the Netherlands. When we look at some legal aspects later on, we'll look more closely at some legal alternatives that exist to manage this revenue risk in this way. Thanks for watching and see you soon.